Hello and welcome to Switzer Investing TV. I'm Paul Rickard, filling in for Peter Switzer. Got a packed show for you tonight. First up, Jun Bei Liu, all the way from Paris, but talking about the Australian market and in particular, what some of the negotiations going on about trade in terms of tariffs will mean for us and some sectors and stocks in the market. Michael Wayne looks at the chart. Michael, of course, is the Managing Director of Fairmont Equities. What's the US S&P 500 telling us and what's the S&P ASX 200 telling us? Can the market go higher? Michael doesn't think it's too badly positioned, so stay tuned for that. And finally, a little different flavour. Let's look at gold because gold's in what many people are talking about as quite a long-term uptrend. And I'm joined by Jordan Alicio. He's the General Manager of ABC Bullion. First up, Jun Bei Liu. Jun Bei Liu, of course, is a regular on the Switzer TV Investing and is the Chief Investment Officer of TenCap. Welcome, Jun Bei. Great to have you on the show.
Thank you for having me today.
Now, you're a little bit closer to some of the trade action than we are. We've seen a bit of a movement on US markets, futures on a Sunday night. Are we getting closer to resolution with China, and is that a good thing for the market?
It certainly sounds like it. Certainly, if you listen to what Trump said, that they're getting close, and they are. Looks like US will make an announcement about what the details are. Now we're still speculating. Is it 80%? The number he floated is a 40. So there's still a bit of a sort of a guess of what it might be, but any outcome I think is positive for the market.
And which, let's say we get a good outcome, in other words, a lower tariff, the market's more comfortable, which sectors or stocks are more likely to benefit in the Australian market?
I think first of all, the companies, there's only a handful of them that's been impacted significantly. Company like Breville, company like Ansell, the share price is still down from the date, the Liberation Day, if you like. That's right. And so these companies should benefit in terms of share price, should have a short-term lift quite meaningfully. And then looking through other companies that might get impacted, will have a boost. Is resources companies should have a bit of a boost because share price has languished because of fear of global growth and the like. But now we got to be just a little bit careful of not to get too excited. Is that we're not going back to no tariff, but we're going back to some level of tariff. So global growth is still going to slow. So whatever the short-term uplift we get, may well reverse somewhat because the market has been strong into this. But we do think that this week we should get a bit of a boost.
Given that the last month or so we've seen sort of I'm not sure it's a flight to capital, but we've certainly seen better performances of the European markets and Asian markets generally compared to the US. Do you expect that to continue? And what might that mean for the Australian market?
Look, Australian market actually has been beneficiary of it. We are seeing a lot of flow into our large cap companies, including CBA. Hence why it actually performed quite well when the market was becoming very volatile. So look, I do think though a lot of those money that come out of the US really taking profit. US market has been so strong for so long, and we just seen a little bit of institutional investor reallocating some money into markets that's been lagging behind. So even if we get a stability in trade outcome, we get all of these things happening, I still do think that there will be that continuation of money looking for essentially higher return markets, especially when world return to a normal growth, and then US economic activity, you can't help but expect them to slow in the next few quarters.
And do you think Australia is included in that category?
No, I don't think so. I actually think, that's right. So Australia will become a beneficiary of it, of the capital flow through out of the US. But our economic activity actually will be pretty good. So we are actually just started that rate cutting cycle, and then many are expecting 3 to 4 cuts this year, with one starting very soon. So that should give our domestic activity a bit of boost. So we're seeing the housing market start finding some stabilization. We're seeing consumer finding stabilization, from recently out of Macquarie conference, many consumer company has reported decent numbers. So, so I think our economic activity have found its trough and it's on the way back up. So we're in the better position than many.
Okay, well, that's good to hear. And I guess a lot of our viewers will be pleased to hear that. I want to come back to some of the things you're doing inside your fund, but I just want to get your take last week on the bank results. We had ANZ, Westpac and NAB reporting, plus we had Macquarie. Let's just put the three commercial banks together. Any standout for you in terms of those results from the three big banks?
Yeah, look at to be honest, I thought the result were pretty ordinary, but as expected, they are past their peak activities, so margin was under pressure. Volumes a little bit challenged, and in some couple of banks, in particular ANZ, they're not neutralizing their DRP. That's in a way is almost like protecting their own capital, almost like a quasi equity raising. So it's just a sign that the bank's earning has been, well, it's as good as it gets now. We are on the way to the other side, and then the capital return story is almost coming to an end now. They still all have the buyback in place, but I think it's just getting a little bit harder from here on. So I kind of feel they've been stellar performers in the last year and a bit. It's probably coming to an end. CBA quarterly update this week, so we think that should be okay. Being the best bank and all, super expensive, but I think that result should be quite decent.
Yeah, that was one of the interesting things looking at the analyst reports, as you said, on the three big banks, the ANZ not neutralising its dividend, which if you're not sure what that means when the shares that are issued under the dividend reinvestment plan, they actually buy on market, so there's no net issuance. And quite a few analysts did comment in terms of not capital constrained, but certainly starting to point to the fact that they're not going to get much better on the capital side, and maybe we've seen dividends as high as they're going to get for those three banks. That seemed to be a pretty common theme. Let's look at Macquarie on the other hand. It reported better than expected and has gone up 4 or 5% and another couple of percent today. Still more upside in Macquarie?
Yeah, look, I think so. So Macquarie has underperformed the other banks, so it's a relative game at the moment we're talking about. And for a result, there was a lot of expectations that Macquarie will miss its earnings, given that it's cycling some strong earnings numbers, right? So there was a bit of expectation of weakness, but they did it. And then post the result, even though they didn't quite give guidance, that was a little bit of a disappointment. But again, that was expected because now they sold their the funds management Delaware business. I think there is quite a lot of capital at play. And then in the world, if the US, we can have some sort of certainty with the trade, I think that was beneficial for capital market activities for Macquarie Bank.
So it's pretty leveraged to the US trade outcome, I guess, is sort of what
I think so.
Yeah.
More so than the domestic.
Okay, let's turn to sort of where you're looking at the moment, and I guess some stocks that have been left behind or haven't really rallied are still suffering from from Liberation Day. What stocks are in that category at the moment?
Yeah, so there's quite a lot of stock in that category, and some are interesting, some are a little bit risky. So the likes of Breville, clearly make most of their goods 90% from China and then ship it to US, half the market. And share price still down 15% from highs. We've got Ansell, makes a lot of its products out of Malaysia and Sri Lanka, and then that's being hit as well. And then we actually have the likes of Reliance. But what's interesting that I think Reliance is very interesting because company has already given guidance based on a worst case trade outcome, which is 147%, and the share price had yet to recover. So that's where we see opportunity. Whereas company like Breville and Ansell share price actually has come back in a big way, still down, but it's sort of come back a little bit. It's a little bit risky, so a company like that, we're seeing a lot of opportunity. Fisher and Paykel is another one. Already got everyone to downgrade their earnings, but now if there is a good trade outcome, then perhaps it's the earning might get upgraded.
Right. So you've got Fisher and Paykel, you've got Reliance, you've got Ansell, and potentially Breville. Are there some companies you're not touching that have lost ground and just haven't recovered and are sort of in the unloved category, and you think they're just going to stay unloved? Can you just point to some examples there?
Yeah, there's quite a few. Things like James Hardie. I guess that's a really hard one. Much rather to be buying Reliance than James Hardie. I think James Hardie, the main problem is the purchase of the acquisition, and then the underlying sort of housing data in the US is very poor. So we kind of sort of still waiting for those data to improve, and yeah.
Okay. Anything else that you'd like to say from you, Paris? Anything taking your fancy looking when you look back into Australia from
Look, I
10,000
actually
miles
think.
away?
Yeah, look, I think Australia is well positioned. We are insulated somewhat from the trade uncertainty because there's still a lot of detail to come through. We're somewhat insulated. Our economy has, coming off the bottom now, started to getting a bit of momentum. Our election outcome just gives the stability of what is to come. So I think Australian equity looks very strong. And we like to buy companies that kind of, has been like in some of the cases laggards. Banks probably is less excited about. It's really about the next level of companies coming through whose earning are going to have that, the cyclical tailwinds, your retailers, your domestic cyclicals that will do well.
Yeah. Yep. Well, as always, some great insights. That's Jun Bei Liu. Jun, of course, is the Chief Investment Officer with 10Cap.
Thank you very much.
Now, let's have a look at the charts, and to run through the charts on both the US S&P 500, the ASX 200, and a couple of stocks. Here's Michael Wayne. Michael is the Managing Director of Fairmont Equities. Thanks for joining us, Michael. Let's start with the US market, obviously the key indicator, because I guess our market in many cases follows it. US S&P 500, we've got the last 3 years down at the bottom. What's your view on the US market?
Yeah, so look, with the S&P 500, I've actually just zoomed in a bit for this one on the daily chart to show the major moving average that everyone keeps an eye on, and that's the 200-day moving average. So obviously it's bounced really well off the recent lows, but it is coming right up to the underneath of that moving average. It's closely watched. It's providing a bit of resistance so far, so we could see that over the past week, the US market has essentially traded sideways for that period of time. So we're getting a bit of selling pressure. Look, longer term, I think it's quite encouraging that the market was able to recover that much ground in such a short amount of time. It's a good sign, but I wouldn't be surprised if it does want to have a bit of a dip. There'll be a narrative such as empty ports in Los Angeles or whatever the reason will be, but look set for a bit of a dip here.
A bit more consolidation, maybe a bit of a dip. That's just sort of your view.
Look, it's a possibility, but look, the pace of the move has been pretty strong.
Yeah.
So we might find that it's above this line pretty soon. And essentially, what I'm trying to say is we're at a level where there is a little bit of a consolidation going on. Once it gets above that blue line, it should draw in more buying. More shorts will start to get closed off, and then the second leg can commence.
So you have no reason to view that the bull market is still not firmly in place?
No, look, I mean, at this point in time, look, we've done a lot of buying already. Any new buying, I'd like to see it crack this
Right.
blue line. So you don't have to get super aggressive at this point. Just let this consolidation play out. But longer term, I think there's more upside in the US market.
Okay, longer term upside, maybe some consolidation at current levels. Okay, that's the US market, which does, unfortunately, or in many cases, set the pace of what's going on in the Australian market. Let's have a look at the S&P ASX 200. Again, we've got the same 3-year time horizon, a super bounce back in the Australian market. What does that say?
Again, it bodes well for our market. So this blue line is a line that I've spoken about a few times on this show. So previously it was a major resistance level for our market, and then about a year ago when it broke above that line, it set our market up for a nice rally. And the reason why I'm talking about this line again is because we could see on this weekly chart the recent dip in the market saw our market briefly go under that line, and it's around 7,600 on the ASX 200. But by the end of the week, we were back above that line and we've never looked back. So again, good sign of strength. We could see that in terms of the decline from peak to trough, we've recovered most of that already. So good sign of strength, but obviously, if you didn't participate down here, you don't really want to be chasing the rally just yet. We need to look for dips and better opportunities. But again, longer term picture, it's looking good for our market.
So no reason really to de-weight out of Australian equities from what you can see from the chart. Is that fair to say?
Yeah, I'd be looking to purchase things on dips.
Right.
Yeah.
Still a buyer on dips, all right?
Yeah.
So Peter will be happy about that because that's sort of his mantras. But let's look at some individual stocks, starting with Macquarie, which reported last Friday, and the markets rallied on the back of that report. This stock hasn't quite recovered to where it was before we went into sort of the trade wars. What's your feeling about Macquarie at the moment?
Yeah, I think it's looking very good. This is one of those stocks that we're happy to pick up for clients that weren't holding it, during all that turmoil in early April. So obviously it's fallen quite a way since the original peak there. Of course, with Macquarie being, it is quite a leveraged exposure to the market. So when the market falls, Macquarie tends to drop quite a bit, but it works both ways. So yeah, it gave up a lot of ground during that sell-off, but the Macquarie chart looks like a lot of stock charts, as you'll notice. You've got this big decline here, the bounce back, and then a bit of a sideways. All right, what are we doing now? Are we going to dip again? Are we going to head higher? Macquarie seems to have resolved that question in the past couple of days by pushing out of this range above $200. So it does look like it's on the way.
So could well find a base now around about $200.
Yeah, I think we've seen a good low in Macquarie, and the way it's trading on the chart, it looks like it will recover. I think once it gets up to sort of the 220s, you'll get a bit of resistance again. So we could see that it's provided turning points in the past for that stock. But yeah, for the moment, very nice momentum, and stock I'd be happy to continue holding.
Okay, let's talk about another bank. Westpac also reported last week. Market didn't really like the report. In fact, a little bit disappointed. Westpac sold off on the back of it. All the banks look pretty expensive, but what is the chart saying?
Yeah, look, it doesn't look as great as, say, a CBA, which is just continuing to head higher and higher. With Westpac, so this is a weekly chart, we've noticed that it has been fairly range-bound since mid last year. Yeah, there have been a couple of occasions where it's sort of dipped out of that range, but generally it has been range bound, and we're looking at sort of $30 to about $34. Now, at the moment, it is sort of in the middle of that range or in the lower end of that range, and it has been falling recently. So unlike Macquarie, which is now on the way back up, Westpac over the past week has been losing ground. So doesn't look as bullish as Macquarie, of course, doesn't look as bullish as CBA. So look, I think that with Westpac, it'd be interesting to see what it does around $30 because it was a strong level of support previously. If it starts trading with a 2 in front of it, I'd be concerned that the sell-off is starting to gather pace. So one that I'd be happy to sit on the sidelines with for the moment.
Yeah, the analysts weren't overly impressed with the numbers. In fact, it probably was the worst of the bank reports, I think. But then again, it was the best last time. So you put that two things together. But they seem to be, as they go through this major program with Unite, I think they call it, a lot of work to do to change the systems and change the processes at Westpac, and maybe that's just slowing up some of the earnings momentum. Okay, finally, I want to talk about one of the resource companies, BHP. It's been well supported today on the back of a bit more news about its a copper mine in Chile, I think, is a bit bigger than previously forecast. But resources companies are doing it tough. This doesn't really look like, looks a bit of a downward trend on BHP. What's your take on BHP at the moment?
Yeah, so this chart only goes back several months. I am looking at a bit more of a shorter term chart in this respect, but I think commodities can finally do very well this year. They've, they have been a bit unloved over the past several months. The money's been flowing into financials, been flowing into tech. But, we are seeing decent numbers coming out of China. Obviously, we've got sort of a bit of movement happening in terms of trade deals. US dollar coming down now, which is a positive for commodities. I mean, the sector's been unloved for so long that I think we'll continue to see when the sector's been unloved for so long, it's been starved of capital. So I think supply out there in terms of copper and other commodities, that's going to bite, and we'll start to see higher prices. So look, I'm quite optimistic for this year. But look, coming back to the chart, this short-term daily chart, very interesting price action. So there used to be a strong level of support here around 38.50, sort of in the mid 38s. It did break that, of course, when the whole market gave way in early April, but it's run back up to that line. Now, when you get up to a resistance level, I guess there's two things that could happen initially. So, of course, you get some selling. Now, the stock either drops quite rapidly because all the selling kicks in and there aren't any buyers left, or there's enough buyers to sort of offset all that selling. And that's a really good sign when you see that. And I am seeing that now with BHP. So it does look like there is some very good buying support right at this level. And I don't think it'll be very long until the sellers are done and it could pop up above that sort of 38.50 mark. And then recover well into the 40.
Well, that might be great for the resource companies and BHP, but I guess we might also see some selling come into the banks on the back of that, which
it'd be interesting to see if that happens. Yes.
Yeah, which of course are afraid to sell the banks or have been because they just don't want to buy resources. But let's hope that you're right on that front. So, Michael, thanks for coming and sharing those insights with us on Switzer. That's Michael Gable. He's the Managing Director of Fairmont Equities. Thanks, Michael. Now, for a change of tack, let's look at gold with Jordan Alicio. Jordan is the General Manager of ABC Bullion. Jordan, welcome to the program.
Paul, thanks so much for having me.
And we're just looking at a chart on the price of gold there. It's had a huge upward movement. Do you think that this is a structural shift towards gold, or is this one of these cyclical bull markets in gold?
I think it's very much a continuation or perhaps an acceleration of a trend that has really been in place for most of the last 20 years. So again, if you look at that chart, it starts in 2003. Back then, you could buy an ounce of gold for around 500 Australian dollars an ounce. Obviously, as we sit here today, the price is closer to 5,200. So what we've seen in the last 12 months, and there has been a real uptick in gold demand, and the price in both Aussie and US dollars is up about 40%. It's been a particularly strong year, but it's a strong year that is part of a 25-year bull market.
Yeah. So you think this is more structural rather than just cyclical, brought upon by a bit of uncertainty in world events. Is that what you're saying?
I think so. I think the current volatility in markets and the uncertainty regarding trade policy and the like has certainly sort of accelerated the price gains and the demand. But again, the long-term chart tells the picture. Gold has been in a structural bull market really since the turn of the century, and that's what we're seeing play out.
Now, central banks typically hold a lot of their reserves, their currency reserves in gold as well as US dollars. How important are central banks in terms of driving the underlying demand for gold?
They're very important. They've always been large players in the gold market. So even around the let's call it the early 2000s, even though central banks had been net sellers of gold for the better part of about 20 years at that point, they still held around 30,000 tons in reserves. That was kind of like the bottom of the market, as it were, for central bank demand. For the last 15 years, essentially, we've seen them adding to their holdings every single year. Now, up until COVID hit and then the invasion of Ukraine by Russia, the average buying was around about 400 to 500 tons a year. In the last 3 years, that number's gone to over 1,000. And so far in 2025, we're basically on track for another 1,000 tons. They did about 240 tons in the first quarter of the year. So yeah, they're an important part of the market. If you think of them buying about 1,000 tons a year, that is roughly 30% of all the gold that's getting mined around the world. So they're a very important part of the market. And if you look at which central banks are buying, it tends to be emerging markets and the like. The expectation, the base case scenario, is that we'll see continued demand from central banks for years to come.
Now, we've got an outlook which says that interest rates in the US are expected to come down. We've also got President Trump and his team talking about a weaker US dollar. Are those things individually good for the price of gold?
As a general rule, yes, they are. I mean, gold is an interesting asset and one of the reasons why people like to put it in their portfolio is it isn't correlated to other markets with a sort of say pure one-to-one relationship. So it's not as simple as saying rates up, gold down, or rates down, gold up. But certainly if you take a longer term view, environments where the US dollar is weakening and environments where interest rates are coming down, especially in real terms, tend to be supportive of higher gold prices. So again, those two factors have helped gold, or helped propel gold as high as it's been in the last 12 months, and I suspect will provide continued support.
Now, a lot of our people watching trustees of self-managed super funds usually have pretty diversified portfolios, shares, bonds, maybe some property. Gold is in some portfolios, but typically what sort of allocation or recommendation would you be making to people in terms of perhaps who just want to have some as part of their core portfolio? What sort of holding do you think might make sense to have in gold?
It's a great question, and I guess obviously I need to start with the obvious disclaimer that I can't give advice, and each and every person is unique. We actually did a survey with our clients at ABC Bullion, and the SMSF market has become one of the biggest components of demand that we see with our client base. And we asked those that had a self-managed super fund that had allocated to gold, what share of their portfolio had they put into gold and silver. We bucketed precious metals together, and we sort of gave them options 0 to 10, 10 to 25, 25 to 50, 50 above. There's a few that have gone in pretty aggressively, but by far the number one allocation bracket, for want of a better term, was the 10 to 25% range, which, and again, we can't give advice, but I thought that was very sensible, in the sense that, you know, even if you take the 25% number, well, by definition, that means 75% of the portfolio is in other things. It's in cash, it's in equities, property, fixed income, you name it. So whilst there's a bit of a perception out there that for many people, gold is kind of an all or nothing investment, actually, when you look at what investors do and how they include it in their portfolio, they tend to be quite balanced about it, which is great to see.
Okay. Now let's move on to sort of how you can buy gold. Obviously, we have, you know, exchange traded funds. You represent a bullion dealer, the physical asset. What are some of the advantages of physically owning gold versus perhaps an ETF? Do you have any sort of point to some reasons why people would actually own the asset, and what is the downside of owning the asset?
Yeah, it's a great question. So I think let's start with the bit that's the same between an ETF and a physical bar and coin, or almost essentially the same, and that is that the return is going to be the same. You know, generally speaking, gold ETFs do a very good price of tracking the price of gold, and obviously by definition, so will a physical bar or coin. In terms of the differences between the two, there's a few. The first is the sort of market access element. Now, this might not be important to every investor allocating to gold, but what you find is that the volatility in gold markets and the intraday moves tend to be more pronounced, both when European markets open and especially when the United States is open.
So that price in the Australian time zone is pretty stable. No?
Correct. So you've got a smaller trade window when buying an ETF, because you're obviously limited to the ASX's hours, whereas a bullion dealer like ours can offer 24/7 market access. You've got the cost element. Now, on this score, the sort of transactional costs, it will cost more to buy and sell a physical item than it will be to pay the buy-sell spread and brokerage fees involved with an ETF. But there's the other cost, which is perhaps not as well seen, which is the implicit, let's call it storage or management costs involved. So if you buy, let's say, a self-managed super fund putting, let's say, 15% of their portfolio in gold, average SMSF's $1 million these days, so roughly 150 grand, that could be stored in a private vault through a business like ours for about $300 a year. That same $150,000 invested in a gold ETF would probably have an implicit management fee built in of a little bit. It'd be more than that as a general rule. And probably what's even more important is that by definition, given the way an ETF is structured, those fees are linked to the rising gold price. So as the price goes up, I mean, great, you've made money, but your fee's gone up as well.
So if you're after, I won't say $150,000 is a lot, but many people it probably is. The bigger you get looking to deal in, the more attractive the physical bullion's going to be over an ETF. Is that?
I think that's a great way of looking at it. And I think, you know, if you stop and again go back to what we were talking about before, central banks, large institutions, there's a reason why they deal in the physical market. It's liquid enough, it's cheap and efficient enough to transact in. But I would say, I think the gold ETFs have been a tremendous development for the gold market. They've helped democratize gold investing. They've, even just through the perceptual value that they've brought. So by no means is it a knock on them by any means, but there are some. The last thing I'd say as well on this around the value of the physical, and again, this isn't necessarily relevant to every investor, but there is something about having ownership that you can have in the hand.
Yeah, it's something you can take out, and if you want to store it at home, you can. But most people put it in the vault.
Correct.
But if you're comfortable under the bed, well, there's always that reason.
That's right.
Look, finally, just I think it's relevant to size. When I was intrigued by one of your articles about Gen Z starting to invest in gold, and I thought Gen Z just being cryptocurrency, but I had to go back and check up what Gen Z is, and I think it's basically people between about 18 and 30, roughly.
That's
within a couple of years.
That's right.
Why are Gen Z suddenly interested in gold, and how are they actually investing in it?
Yeah, it's a great question. I think there's two or three things that have driven, let's call it the Gen Z adoption of gold. And actually the first one actually is crypto. So if you stop and think about Bitcoin, which is obviously the most high profile crypto of all, since day one, what has it been marketed as? Digital gold, right? That is almost the two-word slogan via which Bitcoin has built its brand name, for want of a better term. And so I think if you spend, let's call it now 15 years touting the benefits of digital gold, by definition, you're saying gold's pretty good, right?
Yeah.
So that alone has helped people sort of think about, let's learn a little bit more about gold as well. That's factor number one. Factor number two has been, obviously, gold itself has been, as the chart alludes to, one of the best performing assets for the last 25 years. Young people, they're looking to build wealth. They're looking to invest in assets that offer capital appreciation. Gold has clearly done that. So that's been a factor driving it. And then the last one that's worth mentioning, I think, is accessibility. So whilst there's this perception that you need the 165 grand to invest in gold, which by all means you can put investments like that in, and indeed much larger amounts, gold is actually very accessible to investors irrespective of their budget. Right. So whether it's a 1 gram tablet, which is a couple of $100, or we offer a savings program, which you can access as a direct debit from as little as $50 a month.
Yeah.
Most people use it, put in about $100 a week kind of thing. So it just makes gold very accessible. So all of those factors have helped drive that kind of Gen Z, millennial, younger investor adoption. And I suspect we'll see that, continue to grow as their wealth builds, as they're interested in investing in builds. They're obviously going to be the first, or perhaps one of the first generations through which superannuation is going to be such a critical financial asset for them. Yeah. They're contributing at 10+% for life. So I think all of that speaks well for the future of gold investing in Australia, be it in ETFs, be it in savings accounts, be it in cast bar and coin form.
Well, I guess it's a good time to be a gold bullion dealer. So Jordan Licio from ABC Bullion, thanks very much for joining us on Switzer.
My pleasure, Paul.
Thanks, Jordan. Particularly interesting about how Gen Z are getting into gold. Now, a bit of a warning. We know many of you get contacted by people purporting to be someone else. One of the latest things, of course, are investment scams, particularly carried out on likes of Facebook and WhatsApp. If you get a message on Facebook or WhatsApp, it'll never be from us. And be really careful. There are millions and millions of scams going on. Don't reply to unsolicited messages on any of that social media. So be really careful with that. That's all we've got time from. I'll be back at the same time, same channel next week. Thanks for joining us.